and people are going to start really getting nervous about the dollar, and who knows where we're going to be with the elections, or if there's going to be court cases and riots in the streets, and where the Middle East wars are going to be. I don't know. We've had like 4 bombs today that shook my house again. I mean, this is not stopping. So it's got to come to a head, and silver is going to be a big part of that coming to a head.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 21st through October 28th, 2024, while supplies last. This week we feature gold half-ounce backdated Canadian maples at just $110 over melt. We also have backdated silver 1-ounce Britannia at just $2.99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Rafi Farber from the Endgame Investor. Rafi, thank you so much for joining us today.
Good to be back again, Elijah.
Well, it's great to have you today. I did want to discuss what we've discussed many times in the past, the repo market. And you've talked about how really things are coming to a head, probably within weeks or months. We could see bank reserves really running out and a crisis in the banking system here coming. So can you discuss that?
So I had actually a good comment on the video I made on that. And that is, somebody asked, why does it matter if the reverse repos run out? They've been zero for most of history until, 2021. And, you know, there were some, like a few hundred billion. Yeah, that's a small number today, you know. In like 2014, 2015, 2016, but most of history it was zero. So why would it matter if they go to zero again? It's a great question. And the answer is, it's inherent in what credit really is, or how the Keynesian inflationary fueled economy works, right? We're not really a money-based economy. We're a credit-based economy. And, you know, credit is issued, and that's how businesses work, and it's how international businesses work. And there's just circuits of credit with people trusting each other. And the actual money that's supporting it all is very, very low, very, very small amount. And if you look at the Fed's balance sheet, the amount of gold is like 8%, and the rest is just debt, which is credit. And debt and credit are the same thing. They're two sides of the same coin. If the credit supply can't shrink, and it cannot shrink in an inflationary system, then debt can never really default. Because if it defaults or it's paid back and it's extinguished, or it can never really be extinguished, then the business cycle turns, you get a bust, they get the bank crises, because banks don't lend money, they lend credit these days. So what really happened from about World War II until 2008, the credit supply gently increased. The Fed had pretty much control within larger cycles of the monetary system, and the circuits of credit kept going. But in 2008, they all kind of fell at the same time. Then you had all of this bad credit or bad debt, which is really the same thing. And the Fed had to buy it all, put it on his balance sheet in order to keep the banking system going with the fuel that it had been on for the previous decades. And now you have all these bank reserves, right? They bought the bad credit, and they bought it with dollars, right? They said, here, give me the bad debt or the bad credit, whatever you want to call it, and we'll give you these dollars, and you can put them in the basement. And that's bank reserves. But banks can't just sit on reserves. Every bank competes with every other bank, so they have to earn interest on these things. So they either put them in the derivatives market, or wherever they fit to earn some kind of interest, or they put them back in treasury paper, wherever it is that can earn interest, right? And now there are so many reserves that they don't even fit in the system, because there weren't enough. It seems like a crazy statement, but there weren't enough treasury bills for all the dollars in the system, and since they couldn't buy treasury bills, then it would cost them money to hold it. So the Fed said, give it back to us, and we'll give you interest as if you were buying treasury bills. And that's a reverse repo, right? So the banks give the Fed cash. The Fed the banks give the banks give the Fed cash. The cash give the banks treasury paper. Right? So say it's basically a treasury bill, just a treasury bill that doesn't exist because there's not enough. All right. So the thing is, now the banks are used to having all these reserves. They've put them places different. They've tucked them away, like under mattresses and under this like scary mattresses, not like a mattress that you sleep on, obviously, but like scary derivative mattresses where they have all these reserves. And now all the trades that they've held there are dependent on these reserves continually funding those trades. One example that I talk about in the Endgame Investor a lot is the basis trade, where hedge funds, banks, non-banks, anyone who wants to do this, shorts the treasury paper and then buys the spot and profits off the spread. And they use bank reserves to multiply this trade over and over and over again. And if you look at the COT reports, the positioning on these short positions on these treasuries, they're twice what they were the last time they hit a record, which was in 2019 when the repocalypse hit, when the repo markets blew up. And that's what it means, that all these reserves are funding all these derivatives markets. So if they run out, right, if these reserves run low and then these trades have to unwind all on the same day at the same time because of margin calls, then it knocks over other things. Like I'm just trying to picture in my head like what it could look like if you have like let's say a hedge fund that has a lot of these basis trades on its balance sheet, and all of a sudden they run out of repos to fund them, repo dollars to fund them, and they have to close. And then let's say, well, or they need emergency cash to keep them going. Then what if one of these hedge funds has, like, let's say, a lot of real estate and it's got to sell it really fast to stay liquid. So then you have repercussions in the real estate market. I'm saying all these things are connected. So when the reversed repos run out, that means there's no more excess liquidity that couldn't be sopped up by treasury bills, and then reserves start to fall as they get used up. And there's some point in there where things start to unwind. And that's the point where the Fed's going to have to go in again. Exactly what they're going to have to do, I don't know. But last time they went back into repos and there were like $500 billion in repos offered the next few months, something like that. But the balance sheet's going to expand. And then the question is, what is it going to spill into? Last time it spilled into some kind of disease out of China. Let's not speak of it. If that was connected or not, we don't know. And I'm not going to make any claims here, but could have been. We'll see what happens this time. But it's going to be the same story, just like twice as big.
There is the argument to be made that, well, was a lot of the financial aspects that were, tied to the pandemic, were a lot of those problems actually not necessarily related to the pandemic itself? Your perspective on that?
They could have been. Look, there's a lot of theories, and none of us are ever going to know because we don't occupy these halls of power. But I mean, there are theories as to, the repocalypse happens in September 2019. The pandemic was technically, from a biological perspective, already happening at that point. People were being infected. It was spreading. It just didn't make the big news yet. And then, by January, February, which is the repos were ongoing. I have to check the chart, but I think it was like tens of billions of dollars a day. And the balance sheet was going back up. But some people say they needed an excuse to print money more directly. And so shutting down the world might have contributed to that desire to do that, to stabilize the monetary system, but give an excuse to do that. That it's possible. I mean, a lot of people are very insistent that that's what the truth is. I'm just going to maintain an agnostic stance on that because there's nothing I can do about it. Whatever happened, I don't know. I just know that when you print more money, gold and silver are going to go up eventually. And one more, and my thesis is one more printing round, and it's going to happen. So, it's interesting because we can really test that theory in a few weeks or months, right? We know the reverse repos are going to run out. We know that once that happens, bank reserves are going to fall. The Fed admits this, they admit explicitly in their papers, right? They say this bank reserves are going to fall, and then we're probably going to have to slow down QE. They say this. Oh, it's clear. It's obvious even to them. And now, if the pandemic was related in a monetary sense to the repocalypse of 2019, then we should see something like that happen again. Some other excuse to pop up to print trillions of dollars to alleviate the monetary tightness that the repocalypse is a symptom of, right? It means that there's other problems somewhere, but the repo is just one symptom of it. So if it's true, if they're right, then I don't know, God forbid it would be a big war. I mean, the stage is definitely set in the world for that, and we see it everywhere. We could have some election problems in the United States, some riots on either side, depending on who wins and who loses and who accuses who of cheating. This is all primed to explode, and we know it. I mean, imagine living like in 1914, right before Franz Ferdinand was assassinated, and then World War I breaks out. I mean, I'm not saying that World War III is going to break out like in a few months, but we're in the same sort of situation where the chess pieces have been aligned on different sides, in politically, geopolitically, in the Middle East, China, Russia. It's all ready for something to happen. We don't know what.
And you mentioned how the last time we saw this, obviously there was a big crisis, but this is probably about twice as big as the last time. Is that correct?
That's a heuristic. I don't know exactly how much bigger it is, but the reason I say that is that if when the mainstream media, I mean, I guess the decent parts of the financial mainstream media, like I'd say the upper class of it, like FT, and they get more academic and more deep into it. They have some good writers there. When they were talking about the basis trade that's being funded by Repo, and they started like getting nervous about it, they were talking about 2019 and the apocalypse, and they were looking at the volumes in the 2-year treasury. For some reason, the 2-year treasury has the highest liquidity. So most hedge funds, when they want a basis trade and to snip that little penny off of the difference between the futures and the spot, most of them pick, or a big proportion or a plurality of them pick the 2-year. Right. So when FT was reporting on this, the amount of shorts in the 2-year treasury note were at records at the time. And then they said, oh, don't worry about it. It's going to go down now. The basis trade is out of style and everything will be fine. It's worse than 2019 now, but it's going to go down now. That's what they were saying in their tone. I don't know how they proved it, but they were wrong. Because now it's at even bigger positions. I forgot the number, but it's an all-time record high, and it's twice the amount of the basis trade in 2019, which was funded by the same repo dollars. Right. So I'm extrapolating. If the 2-year basis trade short is twice as big as it was in 2019, then the problem, at least from that perspective, is at least twice as big. It's probably bigger than that. But I mean, I remember the story of who's that guy, Zoltan Pozsar, and he became famous for like plotting out a map of the financial system and how the 2008 crisis, created a slew of dominoes and they all fell, and he was mapping everything out, and his map became famous. You'd have to be that good in order to figure out exactly how much bigger it is now than then. So I'm saying it's at least twice as big. It's probably bigger.
Now we see gold reacting quite a bit. We've covered this, but it's hit even higher all-time highs since the last time we talked. Silver is breaking out above the $30 level, sustaining above that and breaking into the 33, 34 price range. Your perspective on this recent move that we've seen in both gold and silver?
I mean, what's surprising to me is that gold hasn't had much of any of a correction for how long has it been? I don't even know. It's been months. And on the one hand, like, I'm emotionally ready for a correction. Like if gold were to go down 50, 60, 70, even $100 in some kind of like little crunch, it wouldn't surprise me, but it's not happening. And I looked at the commitment of traders in gold, right? And the worrying thing is that the bullion bank short positions are very near a record high in gold. But what I also noticed is that you go back all the way to 2008, 2009 to 2011, the strongest portion of the gold bull market of that era was after the 2008 crash, right? And then gold goes something from like 642 to 1923 what was it, from October 2008 to September 2000. So about 3 years. It goes from more than triples, about triples. And in those 3 years, the COTs, the commitment of traders, whose position what in the futures market, if you trust those numbers. I don't completely trust them, but I think they're basically accurate. Maybe they look very similar to now. And for most of those 3 years, the bullion bank shorts were at or near records for 3 years. So I'm saying, like, yeah, we're in a dangerous position where you could get people knocked out especially if they're in leverage or doing some kind of crazy trading strategy with options, which I never ever recommend. But those people could get kicked out if they're just trend followers or if they're hedge funds or something. But then again, we had 3 years of this from 2008 to 2011, so we could have that again, and we could just keep going higher from here, just like we did in those years. I don't really know. I'm not gonna try to play it. With silver, silver didn't really make a move until 2010, 2011. So 2008, 2009 didn't do that much. Same thing in the 1970s, like from 1975 to 1979, silver did basically nothing. And then all of a sudden, 1979, 1980, the last half of 1979 into the first 3 weeks of 1980, silver just goes crazy. That's a signal of the public finally waking up, right? The banks wake up, the financial players who see a little bit deeper what's going on in the derivative system, they make their moves in gold before the public finally wakes up. What makes the public wake up? Well, not the derivative markets, the supermarkets. That's what makes them wake up. Then they go for silver. So we're going to see that at the very, very end. Where silver is going to go in the very, very end, of that cycle, in the hundreds, maybe even the thousands. I don't know. It depends. These numbers don't really mean anything when the dollar doesn't buy anything. So it's anyone's guess, but I do think that the ratio, at least briefly, will fall to 15-1, which is what I'm waiting for. And when that happens, I'm just going to buy a bunch of stuff with silver, and whatever I can't buy, I'll just convert back into gold.
Now, you mentioned how, you wouldn't be surprised to see somewhat of a correction here, but you've also said that there's no signs that gold or silver are in a bubble right now because the retail customer really hasn't woken up. We're still seeing significantly, the premiums are not too high right now, and demand here at Miles Franklin is, maybe a bit better than it was a couple months ago, but nothing off the charts. So your perspective on that, when do you think the retail customer is going to jump into this?
That's a good question. I don't know when. Look, it's a double-edged sword when you talk about premiums. Because on the one hand, you could say premiums are very low, and therefore we're not in a bubble because we still have the retail the retail buyer to come in, and they haven't come in yet, so there's more fuel. On the other hand, if you look at the premiums in 2010, 2011 for silver, junk silver, like the quarters, dimes, half dollars, those kind of 1964 and earlier, they were actually below zero, right? It means it was cheaper to buy physical silver from, I don't know specifically Miles Franklin, but a retailer in a coin shop than it was to buy SLV, right? Briefly in 2011, like let's say when silver was like going from 40 to 50. So for like a few months in that time span, it was cheaper to buy physical coins. That's a sign that silver was in at least a derivative based bubble, right? It was the hedge funds and whoever buys ETFs and futures. They were chasing the silver price higher, or they were caught in some kind of spiral, and it wasn't being reflected in the physical markets. Now, premiums are low, but they're still positive. It's still, it still costs a premium. I think it's like 6-7% for junk silver, which means that there's still some demand in physical markets. So it's not like buyers have totally given up and they don't even want it, right? Which was the case in 2011 briefly. So look, when do the retailers or the stackers come in again? I think when the next printing round starts, right this is going to be after the next repo crisis, and the Fed's going to have to say, look, we're going to have to cut back down to zero, or we're going to have to cut 100 basis points overnight, something like that. I think then the premiums are going to start to rise again, and people are going to start really getting nervous about the dollar, and who knows where we're going to be with the elections, or if there's going to be court cases and riots in the streets, and where the Middle East wars are going to be. I don't know. We've had like 4 bombs today. that shook my house again. I mean, this is not stopping. So it's got to come to a head, and silver is going to be a big part of that coming to a head.
It's just there are so many uncertainties in the world right now that, I mean, it's quite concerning, and no wonder why gold is, acting the way it is. But I think it's so important to not be reactionary, right? But to, have a portion of your finances in physical precious metals so that we're prepared for whatever comes our way. And I think that's largely the point of the end game investor, is really being prepared for the end game. Can you tell us a bit about the end game investor on Substack and what people will find there?
Yeah, well, so what I'm basically trying to do is, if you understand that there is a serious problem, but you don't really get what it's about. I don't completely get what it's about either. I don't understand everything, but I can give people the intellectual backing to be sure that this is the right direction. It's not the only direction, but it is a right direction. Right? Depending on your talents, you're going to go in different directions. If you're an engineer, you can build things, and you can if you're a farmer, you can start planting. But if you have no skill, if you really don't have any skills, or any skills that would apply in a breakdown of division of labor, then what you want to do is you want to stock up on gold and silver. And the way to not be worried that, well, what if that's not right? What if silver loses value? What if gold is we just agree on the value and we don't agree on it anymore, and it's not much? No. I'll give you the intellectual backing to understand that it is. You don't have to worry about that. Like, I'll make sure that you understand that, so you'll be emotionally comfortable with stacking. Right? If you're apprehensive about it, I can help you understand that you don't have to be. And it doesn't mean you have to convert everything into gold. So that's crazy too. Like, you need to stay liquid, you need to stay in some amount of dollars. But so just to sum it up, like, I'm trying to keep people emotionally balanced. Really, I'm trying to keep myself emotionally balanced, and that's how I do that, is I communicate what calms me down to other people. Right. And that's how I can maintain my positioning here, and no gyrations in the market are going to scare me out. Right. And I'm not going to be irresponsible with leverage, and I'm not going to, play crazy options with huge amounts of dollars. So that's what I encourage my subscribers to do. And the more you read me, the more you'll be okay with it, and realize that I'm onto something. We're all onto something. But, follow me, you'll be okay. I hope.
Fantastic. Well, we'll put a link in the description of this video here so people can check that out. Rafi, thank you so much for your time. Any last thoughts before I let you go?
As always, just maintain calm. It sounds bad, but really we should embrace what we don't know, and we don't know how bad this is going to be. Maybe for some people it's not going to be that bad at all. Maybe it's only going to be bad for people who are in huge cities, huge, very, very blue cities, where there's like San Francisco or something. I wouldn't want to be there, but maybe for other people, like in Wyoming or Nebraska or Arizona, maybe it'll be fine. Maybe. So we don't know. Just stay calm and do what makes sense, and maintain community. That's all.
Fantastic. Well, thank you so much, Rafi, and God bless.
God bless you too.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 21st through October 28th, 2024, while supplies last. This week we feature gold half-ounce backdated Canadian maples at just $110 over melt. We also have backdated silver 1-ounce Britannia at just $2.99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.